So you're self-employed, you went to your mortgage bank and they basically told you, hey, you cannot qualify for a mortgage, right? Yeah, I've heard the story all far too often, right? But if the bank told you couldn't buy, it doesn't really mean you can't buy. It just means that you went to the wrong place or they can't help you buy. See, getting denied is not rocket science. Doing a mortgage is not rocket science, right? You usually get denied for a particular set of reasons. I'm going to go over those particular set of reasons. Then I'm going to talk a little bit about what they actually look at, what banks actually look at, and how we can kind of change that mold for you, right? So first, let's talk about the 5 real reasons banks say no to an applicant like yourself when you're either self-employed or your income's a little wonky, not traditional W-2, full-time, all that stuff. We don't all have the luxury and the benefit of doing that. I feel you, trust me. But I want to help you. My name's Joel. I'm an expert in non-traditional financing, non-qualified mortgage financing, right? Whatever that means for you, right? But what I do is I help people with complex financial situations qualify for mortgage loans here. That can mean anybody that's self-employed, anybody with heavy assets, no income, anybody who just really doesn't fit the traditional income mold and can't just walk into their local Chase, Bank of America, Wells Fargo bank and get a mortgage loan, right? So let's talk about first the 5 main reasons the banks will tell you no. Number 1, your taxable income, what you declared on your taxes are way too low. See, when you're not a W-2 employee, what ends up happening a lot of the time is the banks are going to look at your tax return, right? Now you could have made $200,000, $300,000, $400,000, right? And it doesn't matter because we as law-abiding citizens, of course, get to use the tax code to our advantage, right? And we get to write off as much as possible, right? But we're really keeping a little bit more than that. We just get to use the tax code to our advantage. What ends up happening is that now, because of all those write-offs, you have a way lower net income basis than you did a gross income, right? So gross income is what you're going to earn at the top. It's like gross receipt of sales, all the revenue that you brought in. And then on the tax form, after all the expenses on that form, right? You're going to get to the bottom little line that says net income. That's what you pay taxes on. And then you try to bring that number to the smallest number possible so you to pay the least amount of money in taxes. But unfortunately for you, the banks are going to look at that net income and qualify you on that. What happens is that can affect your debt to income ratio because that can affect how much you can actually qualify for. Number 2 is, hey, if you're self-employed and you've had income declining over the last 2 years, that's a big no-no to banks, right? So W-2 doesn't really matter if you lose your job and go to a lower paying job. They're still going to use that lower paying job's income. What ends up happening is if you have a big declining income, the banks are going to be like, hey, you're self-employed. You're not stable enough. You're too risky for us to use. We're not going to give you this loan and we're not going to approve you. And that's I feel like it's a disservice. Sometimes we have bad years. Sometimes we have good years, but the good years are way, way out of proportion to what the bad years are. And I think that gets blown out there. So that's a second reason for you there. Number 3, this goes in kind of in line with your write-offs. You wrote off too many items. Because of your write-offs, you have a lower net income. But what the premise of that lower income is this thing called a debt to income ratio. When you have a lower income, right, the way the bank qualifies you is they take the amount of income you earn on a monthly basis, right? And they divide, and then they use the amount of debts you have on a monthly basis. They divide that by the income. So to give you a very basic example, you make $10,000 per month. Your debts and your monthly payments are $5,000 per month. That means you're at a 50% debt to income ratio. So when the bank goes to qualify you, they're going to say, hey, you make $10K a month, but you have $1,000 in obligations between personal loans, student loans, credit card minimum payments, any other type of loan that appears on your credit report, right? You have $1,000, meaning you have $4,000 available to go buy a home, right? And $4,000 home payment is going to qualify you for, let's just say, a $500,000 home. You're pre-approved for a $500,000 property. Lower income, lower debt to income ratio, lower pre-approval qualified amount. That's the unfortunate reality of when you do too many tax write-offs. Number 4, credit issues, right? Sometimes, a lot of times, right, we as self-employed people or anything in reality is, we don't really want to pay a lot of taxes. We're actually really, I would say you're actually really responsible. So you decide to pay things with cash. You decide to not have debt. You decide to really not take on too many credit accounts. And I've seen it way too many times, right? Or all of your credit accounts are on your business accounts, so they don't report on your personal credit. So you're really lacking that personal credit depth, right? And that can cause the bank to actually deny you there. But again, they have their traditional guidelines. They have guidelines that really cannot be moved. So they're not really doing that, right? And number 5, not enough documented reserves, right? The banks going to sometimes want to see 20% down, 25% down. They're going to want to see you make a large lump sum payment and then have reserves to cover all the rest of the stuff that you have to pay. That's a big hit because it's going to take you a lot more money than the average person would need when they wouldn't even maybe need 1 month's reserve or any month's reserves for that matter. Now that we talked about what the bank is going to deny you for, let's go ahead and talk about what the bank is looking at. I think I touched it a little bit in that last section, but if you're self-employed and you have some sort or some level of variable income in any sense or in any case, right? The bank's going to look at primarily like income stability, right? The bank wants to see that you're making the same amount of income year over year, if not the same, but not higher. And I think that's a little bit unfair, right? I think that, just because you have a little bit of a down year or your income's like that, but if you went from making 400,000 and you went to making 250 or 300, that bank's going to say, oh, that's a big decline. That's a more than 25% decline. We're not going to approve you for this mortgage, right? So that's crazy to me, right? The banks are going to look at a 2-year average return when you are self-employed and trying to buy a home, right? Because they want to make sure they don't have a W-2 that you can use. And this is the craziest part. If you're a W-2 employee, you can change jobs. You can go self-employed, W-2 right away from one state to the next. And as long as you get a paycheck stub showing that, they're going to say, hey, we're going to use your W-2 income. Doesn't matter what you did the last 2 years, right? Your tax returns literally don't mean anything. What matters now is that you are W-2 making a fixed income, which wild to me, right? And this is the craziest part about it all. When the bank talks to you about saying, hey, we're doing this because it's a business, but if you pay yourself a W-2 from your business, they're like, hey, no, we still consider that as self-employed because what happens if the business goes under? What happens if any business goes under? So it's kind of a crazy thing, but banks want income stability. They want increasing income averages, especially on your tax returns, which is why we don't conform, or why we tell a lot of self-employed buyers not to use their tax returns, to go outside of the box and think outside creatively, because there are more options and more opportunities out there for you, which is why banks, traditional mortgage banks, are going to deny you, but we are not going to. We are going to help you build yourself up and help you achieve home ownership. And how am I going to help you build home ownership? Well, before I tell you that, I just really want to say, if you're enjoying this channel, please give me a like, give me a subscribe, comment down below if you want more information like this. I would really love to see you just continue watching some videos on my page and spread the love. It would really mean a lot to me. But I'm going to give you a real life scenario of how somebody achieved this exact, of how somebody went to a bank and they achieved this exact breakthrough just by clearly making that small switch, right? So number one, basically, I had one of my clients, they went to a bank. The bank went to approve them. This is somebody who is an AC mechanic, right? He runs his own business. He runs his own very successful AC repair shop, right? When he went to run his own AC repair shop, he obviously bought a lot of inventory, has a lot of material, has workers and trucks and things like that, right? So obviously he's got payroll expenses. He's got W-2s, right, that he's got to pay out. He's got trucks and depreciation and inventory and materials, all of these things which are huge allowable tax write-offs, right? He's even got different items that he can put everywhere. So obviously this gentleman has built up a successful business. He used all that he had to create his business, and now is using the tax codes of which the law allows us to use, right? Went to a bank, a man who is pulling well over $500,000 to $600,000 to his personal name every single year. And the bank said, hey, because of your income, because of all these write-offs, you're not going to be able to afford your monthly payment, right? You're not going to be able to buy a $600,000, $700,000, or even $1 million house that you can really afford, right? You're going to buy a $200,000 condo because that's what you can afford based on your tax returns. And what the bank told them is, maybe next year you can go and you can do your tax returns correctly, or you can do your tax returns enough to qualify for this home and you can come back at it. Here's the biggest problem with that. To buy $1 million home, right, and you're putting 20% down, $800,000, your monthly payment's going to be somewhere around $8,000 and $9,000 a month. It's just throwing that number out there. You, at the very least, have to declare over $250,000 worth of income on your taxes. Now, if you do the math correctly, $250,000 of income on your taxes, depending on what state you're located in. I'm currently in Florida. You're going to pay anywhere from 25 to 30% in taxes on this. Think about that. Think about the fact that if you have $250,000, you're paying 30% of that money in taxes, right? You're going to be putting away almost $80,000 in money going to the IRS. Whereas you can take that $80,000, save it, and put it towards the equity of your new property. So what did we do and how do we restructure this? He came to me and said, hey, I don't think I can get a loan. You know, I have 20% down. I'm well qualified. I have a great credit score. I really want to purchase this home. We restructured the file. I said, hey, let's throw out your tax returns out the window. Don't even worry about that. I'm going to collaborate with your accountant, see if there's even more tax write-off you're missing, right? But what we're going to use is we're going to go based off of the bank statement deposits on your income, on your company, right? And we're going to take the last 12 months of deposits there, and we're going to put an expense ratio. We're going to create, based on your income, based on your company, you probably have a ton of expenses, right? You're probably expensing about 40% of your income. Yeah, that's very true. Great. I got the CPA or the accountant or the tax preparer, whoever it was, to write me a letter stating, hey, he spends 40% of his income on expenses, meaning that we use 60% of all the deposits over the last 12 months as his income. His income came out to close to $800,000 for the year, which made him qualify for $1 million property with ease. That's the power of using non-traditional lending. That's the power of using the bank statement law. That's the power of knowing your options and going to other places other than your bank. So if this has been you, if you've gotten denied, if you've gone to a place and they said, no, you can't buy, and you're self-employed, your income is a little bit different, you don't have provable income, like if you've gone and they said, no way, Jose, but you in your heart feel like, man, I got the down payment, I got good credit, I feel that I'm successful enough to do this and I don't want to shell out money to the IRS to be able to qualify, give me a call. Right? Give me a call, or simply make sure that you're reaching out and that you're asking other people around you. Non-conforming loans that don't follow traditional will only make up about 8% of the global market, meaning that 92% of the global market, the people in the US, do not know about. This is a very specialized way of financing, and I'm here to help you do that. That's why my name's Joel again. I'm the Vice President of Sales here at More Lending. My job and responsibility is to educate you, educate my self-employed buyers, and make sure that I can qualify as many people for the home through the real estate process. And I'm hoping that I can help you too. But if you like this video, please like, subscribe, and continue watching them and sharing with your friends. If you know this could help somebody, share it with your friends. And in the meantime, me and my team are reviewing loan files 24/7 to make sure that this works for you. All right. See you next time.